Good evening, ladies and gentlemen. This is Clueless 8, and this is the end of the day report for a monumental day in the markets. On the downside, obviously, for December 3rd, 2015. So, we're on the third day of December, and the market had one of its worst days in many, many, many months. In fact, one of the statistics that I was listening to on Bloomberg TV said that this was one of the 11 times that the market basically did a somewhere, what is it? A 300-point swing, almost a 400-point swing, up and down. Well, in this case, down. So let me get straight to the point here. I wanted to get into the global macroeconomic game theory stuff a little bit so people understand why this happened. And then we can look at what the surface of the market, which is the equity market or E-minis and the S&P 500 and stuff like that did. So first and foremost, here's a picture that you really don't really follow that much, which is the euro dollar the euro versus the US dollar. Okay? Basically the euro. And look where the euro was. It was at $1.40 back on May of 2014, and it collapsed all the way down March of this year, down to $1.05, attempted a rally, and then hit a double bottom at pretty much the same level, right? So if I chart this here and I looked at this as a stock, it would be pretty easy to read. You got a nice double bottom. You have a cup and handle type of formation, which is about to happen, which is the euro is going to basically spike up to about $1.15 from about $1.04. So do the math. That would be roughly a 10.5%, give or take, type of move from here to there. And then it's going to create a handle, just like a cup does, cup and handle, pure straight line technical analysis. And then it's going to make a move and possibly get up to about $1.26, where it engages the 200-day moving average. In this case, the 200-week moving average, this line. Anyway, why is this important to you and me? It's important to us as equity players on the surface. Remember, the equity markets are on the surface. What happens underneath are the credit markets, the currency markets, and stuff like that. Don't want to get into it too much, but you get the gist. So it's important to us because when this happened today, this was the primary cause for the market pullback. I explained this in my periscopes and I explained it in my comments, but let me explain it for once in a while. Clearly on this video cast. When you get a move like this, which doesn't seem much when you look on a weekly basis, you pull it up on an hourly, it's a see you later story, right? You'd like to see that on the long side on a stock. We are seeing it actually on Alta Salon tonight. One of my recommendations. It's up 6.5%, close to $11. For those who took it, and I know a few of you did, my good friend Vix included, congratulations. And I think it goes higher. Anyway, the bottom line is that when you get a move like this, what do you think happens? It has massive, multi-billion dollar, countless billion-dollar ramifications because a significant amount of the hedge fund community and institutional community and large investment banks included, okay, hedge funds, I'm just going to put hedge, F for funds, or actually writing it out, investment banks, were all short the euro. It almost sounds pathetically stupid that they were short the euro because they figured, and this was truly a contrarian trade. It was against the odds. To guys who were in the betting game, horses or the gamble and stuff like that, you'd know. You know, you take you basically bet on the least favorite and it wins. Well, big money. Well, that's exactly what happened here because all these guys were short the euro. Okay, and when Mario Draghi came up and did what he needed to do, which I think was excellent, and I do understand these things. Okay, so I'm just putting short the euro. They were all short the euro. So they expected the euro to go down. But when Mario Draghi comes out and he basically says he's not going to raise the 60 billion a month or so that they're doing in I believe it's in euros. In QE, he's not going to raise it up to 80 billion. He thinks the economy is starting to improve somewhat and this and that. He did cut the deposit rate. That's another day story. In other words, it's a negative 0.3%. In other words, if you keep money in European banks in the eurozone, it's going to cost you to keep money with them. Forget about getting interest, right? We get a measly interest on our checking accounts and stuff like that. At least we're in positive rate. They get a negative rate. So what happens? It pushes money out to come into the capital markets and in the stock markets. That's sort of the thinking behind it. Why keep money in a bank when you got to pay the bank to keep it, right? Why don't you get a big metal box and keep it under your bed? So that's pretty much the philosophy behind it. Anyway, so he cut the deposit rate to lower, trying to incentivize capital to flow into the financial markets, into the capital market. But in the meantime, he didn't raise QE. I mean, didn't raise the amount of QE. So guess what happens? All these guys who were short the euro got completely bamboozled. Mario Draghi was supposed to bring out a bazooka, right? Which means that he was supposed to, probably raise it to 80 billion a month in quantitative easing and stuff like that. But no, he didn't do that. So next thing you know, the euro shoots up big time, right? It shoots up big time, and you get one of the biggest monster short squeezes known to man. Because the ones who are short, they just scrambled for cover, and I'm sure there was a lot of shorts around this level too, who thought, okay, they're going to make some real money, except they started to lose money big time as this just went straight up. No stop, right? No stop. Didn't even bother coming down, for any consolidation. Went straight up again. So what do you think's happening? Let's say you were short a stock at 10 and it went against you at 12. You're like, okay, maybe it's going to stop there. Now you're short at 10, so you're losing $2 right there. Then it goes to 14. Oh boy, you're losing $4 here. If you're really dogmatic, you're like, nah, this can't be right, It goes to 16 against you as you're short. You're down $6 right now. Well, at some point, you got to capitulate. So as you capitulate, the longs come in too, and this thing shoots up to 18, let's say. So this goes up 80%. And if you held it thinking, oh my God, this thing must come down, it can't be right. Well, you just lost 80% of your money. Well, that's pretty much what happened in the currency markets today. And that caused a massive tsunami of selling that from the European side that came into the into the U.S. side, and here is what it did to the U.S. dollar, right? So let me show that to you. Trying to find something here. Oh, good, I have time on this thing. So if I did the U.S. dollar, I believe I do /DX. Okay. So maybe a lot of you are seeing this for the first time, stuff that happens, but this is the reason why the market went boom down, tried to pull up a little bit, hit some support levels and stuff that we're looking at, bounces up a little bit, and then bang, just gives in. Okay? This is the culprit on the US side. The dollar lost almost 3%, right? 3%? Close to it, a little less than that. Fast. You get these type of 2-3% currency fluctuations, you are not going to have any semblance of rationality on the other side of the market. In other words, the equity side of the stock market side. You're going to have the baby get thrown out with the bathwater. That's exactly what happened today. Of course, there were pockets of strength. Price line was up 9. And I'm going to cover why it's important. With the dollar falling dead like this, and this is great news, by the way, because a strong dollar, by now you should all know, and I've covered this in my video cast too, a strong dollar hurts U.S. exports. It costs more for foreigners to buy our goods. And the dollar was just going higher and higher. If you look at the weekly chart of the dollar, I mean, come on. We were up here from last August. Okay? From last August. In 1 year, the dollar went up 25%. And I think the number was somewhere like $1 trillion or little less than that of US corporate profits were damaged because of the stronger dollar. If our goods are way too expensive, they're going to buy less. With global growth being somewhat slow, they're going to buy lesser. So I hope you understand what I'm trying to say, because it's a lot of macroeconomics here, but it's very simple stuff actually. So the bottom line is that you have a powerful dollar which finally broke. Question I always ask, would you buy this chart? I wouldn't. Stochastics on the weekly saying, see you later, sayonara, we're coming down to reset big time. Big fat sell candle first day. We're going to hit 96 fast. And then we're going to see what it does. That's a 50-day moving average. Now, is this not great for U.S. multinationals? Yes, maybe on a one-day basis it shook the world markets, including our markets. But this is great news for the U.S. multinationals because their profit picture gets better. They get to sell their goods a little bit cheaper to foreigners who are willing to buy our goods. Period. How many companies came out and said that because of the stronger dollar, their profits were weaker? A lot of them did. Okay? So that is great news. So let the dust settle, because when you look at a slightly longer term macroeconomic picture with the weaker dollar and the stronger euro, it is actually a positive. It doesn't happen like that when the adjustment's taking place. Hey? That's just the nature of the business. The other thing that happened, which was the 10-year bond. The 10-year bond, I'm trying to find where this thing is. The TNX, the 10-year bond, went berserk. Right there is the 10-year bond. Look at this candle. It just shot up. This is the yield, okay? All you got to move is move the decimal point, point one to the left. So from 2.16%, it jumped up to 2.3%. Now remember, it's okay for rates to rise because, Janet Yellen's hinting, and with all the dollar and the euro fluctuations going on, with the dollar falling and the euro rising, the bottom line is Janet Yellen openly said she's raising rates. So wouldn't the interest rates go higher? Well, that's exactly what it did. So interest rates just shot up. So if you want to look at what happened today, this is what you want to see. What's today? Wednesday? Nope, today's Thursday. So it actually started yesterday. But look at this. It's a kaboom moment, all right? Big time. So the point is that you had you had another asset class that basically went berserk. So there's a lot of these things hit the markets. The main thing is the hedge funds who were short the euro needed to sell a lot of stuff on their books. Not a lot, but a good portion of it. or maybe not even a good portion of it, whatever. They had to sell in a hurry,